Now on to today's market movers with easy to follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and we are days away from another FOMC meeting. Now, these meetings take on a great deal of importance as we are actually in a real live tightening cycle now. We're going to be looking at using the 10-year weekly options ZN to hedge risk or create exposure to this event. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, the market says there's going to be no tightening at this meeting, but the risk has got to be that they adopt a really hawkish tone, correct?
Yeah, I mean, that's always, I think, the risk when the market is looking for there not to be such a tone. But you have to feel that going into this meeting especially, the way everything is setting up, we just had that great tax passage plan just go through. We have earnings that are on deck and earnings that we've seen already that have been really good. Even if there was a hawkish tone, I don't believe the market's going to take that too terribly.
So you think the hawkish tone, if they have it, it's deserve it. The market deserves a hawkish tone.
It's deserve it, and I believe the market, ironically, even though this is maybe a little contrary to popular belief, the market might take that as a good sign to line up with the underlying economic data, which has been better than expected.
Jamie Dimon at Davos said it a year from now we're going to be worried about inflation. I kind of agree with him, but I still think the Fed's going to be plodding along. So I think they're going to talk hawkish, but I still only think 3 for the year. Now, before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Price and movements are going to vary on these, and we're pricing these up now. The March 10-year was trading at 122.08, Scott.
Gosh, looking at ZN lately and hawkish tone as we just discussed, Jim, doesn't it feel like this hawkish tone is really coursing through the veins of the bonds?
Seems that way to me too,
my friend. So when I looked at the example here today and I looked at the charts and I just thought, my goodness, is this a free fall for the ZN? I thought about taking a contrarian view as I talked about on the intro there. So today I'm looking at buying the week 1 Feb 122.5, 123 call spread for 9 ticks. It's got an underlying currently about 122 spot 08. It expires on February 2nd. It's going to risk the 140 that you put outlay to make a potential 358 to put the trade on. And here's what I think is that when you look at the charts and you look at back a year, a couple years, you look at this area of the ZN at about 122 or so, it seems like that's some relatively good support, at least for now, for things to rechase a little bit to the upside while that hawkish tone potentially wears off.
So if I'm hearing you right, the fundamental argument we talked about is intact, but the market's moved far, and many times there are bounces within a downward move, right?
Very true, and it tries to get ahead of these moves typically and overdoes it.
I don't disagree with you that happens quite a bit, and this time I'm not agreeing with you. I think the trend is your friend. I think everything is lining up good for the stock market, good for risk assets, maybe inflation, and I do think the curve is going to steepen and long end rates are going higher. So I'm looking at buying the week 1 February, the 121 and 3/4, 121 and 1/4. Now, the actual prices on those are 121.24, spot 24, and 121 spot 08. Remember, they're in 30 seconds. Actually, the options are priced in 64ths. Now, you can buy that put spread for 7 ticks. This trade is the underlying is currently at 122.08 and expires on February 2nd, just like yours. It risks 109 to make 390. Thoughts?
I disagree with the direction. As usual, we're kind of on the opposite side, which is good for you because then you can look at your 2 ways to do this here. But here's the reality. I like the risk reward, and I like the expression of there's one way that the market's going to go here because of the fact that there's been this tremendous velocity of the downside so far in the ZN. So it's funny how, though, Jim, in my opinion, how much better priced in some degree your trade is than mine, given the fact that the market has run down so much.
Right, and it's equal distance apart, and yours is 2 ticks higher. I think that's because in treasuries, remember that disaster exists to the upside. If something happens and a big headline hits, 10-year prices tend to go up a lot faster than they go down. That's got to be why yours is priced a little bit more than mine.
And I think you're right on that, because if you look at volatility lately, measured by, say, the VIX index, you also see how that's been ticking up a little bit here and there, while the market's been continuing to rally, at least on the equity side.
Agreed. Now, thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.